Okay, welcome in. This is another Sunday breakdown weekly prep session with you guys. Let's very quickly just run through the calendar for this week. Obviously, this is a pretty big week, but I don't expect anything to happen much until after FOMC, which is on Wednesday. So you have essentially a bunch of things that will be happening. You'll have non-farm productivity on Tuesday. That's a high impact event. You have FOMC rate decision and the budget balance on Wednesday, where the Fed is going to make a decision on potentially cutting interest rates. That's the assumption right now. It's about 88% priced in, right? And then in January and March right now, it's a 68% rate pause and then a 48% rate pause here. Now, the odds of a rate pause continuing in January and March are getting significantly higher now as the market prices in that scenario more on softer labor data. And this week on Thursday, you'll get PPI, which will also give you another piece of the puzzle on how inflation is moving towards the Fed's goal. Okay. Having said all of that, there is a couple of other things that are happening in the macro background that you should be aware of. And I've posted some of them on the trading room so that you guys have a little bit of access to it. The first thing is the prime brokers report and the consolidated positioning. The other piece of the pie or the other piece of the information is the tactical sentiment, which is a little bit overstretched, but not completely overstretched. And then at the same time, the seasonality, which is the second half of December tends to be much more better than the first half of December, as you can see in both the SPX and NASDAQ. Okay. And if you look at the Russell, that's also the case. In the first half of December, it tends to underperform, and the second half of December, it tends to perform much better. Um, then the other piece of the puzzle, which is buybacks. Now, remember, Copper America, they buy back all year round. And this year, I think we've had a pretty we've had the biggest year of buybacks. I think it has been about a trillion plus. Okay, 1.1 or 1.2 trillion, which is a lot of money being pumped back into US equities. But you can see that right now we are entering into a buyback blackout period where we will not see any support from corporate America buying back their own shares. So if a sell-off were to happen, then that's going to be pretty aggressive because you will not have support from corporate America since they're entering the buyback period. Okay, the blackout window. Okay. Uh, so Oh, wait, hold on. The blackout window is officially ending. So they're gonna come back into buying back the market now. Sorry, my bad. Now this is another theme that I think Dylan and I was discussing with Dylan because we read a report from Charlie McElligott from Nomura a couple of weeks back, maybe 2 or 3 weeks ago, where we were talking about the fact that um, this guy was pointing out that next year is going to be an interesting year for buybacks because we likely see buybacks decline on the fact that a lot of this money that is supposed to go into buybacks, right, are going to go into capex spend, right? What is capex spend? That's your capital expenditure, especially for your big tech AI tech companies, because they will rather opt to expand their business through capex, which is already forecasted, rather than doing buybacks. They might do a combination of both. However, this will definitely go down next year. Okay. And capex will go up in terms of AI spend. And this is likely to happen for the next 1 to 2 years, in fact. So this will be a little bit of a headwind for equity valuations. And I think that it is, while it is not super significant because you're talking about maybe hundreds of billions of dollars, um, it is going to hurt shareholder return. And when it hurts shareholder return and shareholders don't like that, that's going to likely be something the market will focus on and fixate on as a narrative into 2026. So please be aware of this thematic trend that will later be highlighted. So I'm mentioning it today for the first time because it's something that is just kind of coming out of the woodworks, but be aware of that. It's going to be one of the things where the news will report on in the future. Oh, corporate America is not orchestrating enough buybacks, and that's because of capex spend, and the market will throw a fit about it. Okay. So we will have this piece of information being priced in the future. Now you can see US equity issuance has been relatively subdued. Um, and you can see the tech bubble in 2000 to 2001, and then the SPAC boom, which was 2020 to 2023. And if you look at that, in relation to where we are, it's not actually that bad, right? So a lot of people who are talking about bubbles, they don't really know what they're talking about because a lot of the bubbles that we're seeing are sustained with higher spend. Okay, now overall risk sentiment. You can see Bitcoin got a little bit of a bounce last week, from 80,000 to 93,000, which was a decent bounce. But then at the same time, remember that you have now consolidation in a bear flag, right? And so this move down plus this suggests that we could potentially, if we continue rejecting this $92,000 level, then we likely come back down to get liquidity from the 70 to $75,000 level, which is where our target has been anyway. Now I continue to buy in bits and pieces because we don't know where the true bottom is, right? So be aware of that and understand that we're not going to be able to time this perfectly, but if you haven't purchased any Bitcoin, I would say buy a bit here. Then when it comes down, buy a bit here. Then when it reverses, buy some more here, right? Whatever. Whichever way you want to do it, go ahead, do it that way. This is not me telling you what to do with your money, but I mean, I think it's a good idea for you to space it out and put your money in when you see it's necessary. The other one that you want to do that with is Ethereum, and it's in a similar formation or pattern where it's kind of in a bear flag. So this is kind of showing me that risk is still off in the market. People are not willing to take on excessive risk because of not, the expectation would be that Bitcoin would start rising back to all-time highs or something of that equivalent. If we look at the 10-year yield, you can see the whole of last week, it spent majority of its time bouncing off support at 3.95, right? And then trying to reclaim the 4.15 level. And we kind of almost successfully got there. But this week, after the Fed meeting, is when this will make a decision. The 10-year yield will either break out of 4.263 area, or it'll break down back into 3.95 and then try to get further down in 3.8. Okay, let's talk about the Fed and all of the scenarios that can possibly happen this week. There are ideally three scenarios, right? The first scenario is a extreme bull case. What is the extreme bull case? Well, if the Fed comes out saying that, hey, we're cutting interest rates right now, Powell says, and at the same time, he comes off sounding dovish, meaning he says, we think that policy rates are too restrictive. We think the economy is in a bad shape, and therefore we are going to cut interest rates today, and we will think about cutting it in January as well. That's dovish if he says that, okay? That will send us up into all-time highs. Very likely SPX will break into all-time highs, and then it'll just keep melting up. Okay, so if that happens, then any dip is buyable. Okay. Then on the other flip side, you have pretty much the bearish angle, rather the extreme bear case. Okay. What is the extreme bear case? The Fed doesn't cut interest rates on Wednesday. Powell comes out saying that policy rates are still uncertain because of the economic data that we have not received during the shutdown. Therefore, we do not have enough information to make this decision to cut interest rates. We want to watch and see how the data is in the next week or so, and then make a decision in the January uh, uh, dot plot. Okay. Now, what does this extreme case do? Well, if that happens, then you'll realize this entire yield curve will move, right? This expectation that you're seeing here, 88, 60, 48, all of this will move. All of this will move, right? These will all move further down, okay? And these will move to the side. And then essentially you'll get an extended period of time with just rate pauses, okay? Rate cut, sorry. So here, this will kind of stay where it is. Then you'll see all of these will move to the right. So your entire yield curve will move to the right, essentially. Okay. And this is gonna cause severe panic, severe shock. No surprise that the market will not like that. And that will obviously send you initially down into 67.50. And then if things get worse, you have all the key pivots down here to guide you through that. Okay. Also, let's have a look at the gamma levels for this week so that you guys have an idea. So I'm going to use the end of day one and quickly just let me set this real quick. This. Give it a second here. And I'll do one for SPY as well. Here. Okay. Now, what is the other case of the FOMC? Well, that is my more expected case. And what is that expected case? That is essentially a hawkish rate cut. Okay. What does that mean? A hawkish rate cut means that we're going to likely see Powell come out, cut interest rates as expected, right? With the 88% at 3.5 to 3.75, and then say that he does not see the warranted need for us to have additional rate cuts anytime soon. Okay. This will be a hawkish rate cut. The messaging in here will be very similar to the fact like this write-up that was here. You can read this write-up right here. Wait, no, not this one. Not this one. There's another write-up. Yeah, I'll post it later. But essentially, he will say something like, policy rates are restrictive right now, and then he'll mention the government shutdown data being not there. They'll mention that the Fed has its work cut out for itself. They'll mention that, they want to take the watch and see approach, which the Fed has been doing for donkey years now, right, under Powell's command. And then maybe he might even mention his unsureness about future policy because of the fact that he will be an outgoing Fed chair and a new Fed chair will come in. So that will be kind of a hawkish situation in which it's a rate cut, but then it gives the market anxiety. Okay. And I believe in that case, the market will not sell off super aggressively, but it will sell off a little bit. How low can it go? It could come all the way back down to 6,600, right? That would be extreme case. That's a possible support level, right? This area with a lot of liquidity. Okay. That means a pretty big move down into this area here. You can see that if you just were to actually go ahead and get a Fibonacci drawn on this entire wave, this one here, right? Then you will see that the next level in which we should come down based on this wave here, because remember you can't use this wave here. You cannot use this wave because this wave is still in motion, right? So if you see anyone using this wave, they obviously don't know how to draw fibs, but you have to use a wave that is already completed that has the data. So this to this is the wave that you can use, right? Because it's completed and then it reversed out of it. So therefore, this is the ratio that you will use for this entire wave. And if you realize the golden ratios, which are meant to for support, right, are down here at 65.98 is the extreme bottom of that, right? So the obvious retracement will be first 67.40, which will be the 61.8 golden retracement. And then below that will be the 38.2 and the 23.6, which is at 66.52 and basically 6,600. So this is where I got the idea from, that the market can potentially pull back to this level in order to run higher in the future. Okay. So that is kind of where I'm looking at in terms of the three scenarios this week. Now, remember something. These three scenarios are going to take the entire week to play out. The first thing is Monday and Tuesday is likely going to be a very slow day because look at the calendar. There's not much going on. Everyone's going to be just digging the market around because they're all waiting for FOMC, which is on Wednesday, and PPI on Thursday. Okay. So the first 2 days of this week, I don't recommend aggressive trading. All right. Now, the bulk of the move that will happen is going to be after Thursday and the next week. Next week is where you're going to see a lot of the move happen. Okay. So my advice to all of you is don't trade aggressively on Monday and Tuesday this week and even Wednesday, because up to Wednesday, the FOMC is at 2 p.m. So therefore, it's not going to be much of a move. What you do want to do is take advantage of Thursday, Friday, and then take advantage of the week after. So hold burning any cash here. Don't trade these days, and then focus on this back half of December or middle of December, sorry. Okay. Really straightforward, really important. Now, on SPY, here are your gamma levels for the week. Let me just make a few changes here so that you guys don't see so much of shit, because you don't really need all of the gamma. Remember these gamma levels, the most important ones are the first three. I mean, this is the biggest gamma level, second biggest gamma level, third biggest gamma level. Honestly, we don't even need three, we just need two. So let me just amend that. Okay. So you can see majority of the gamma, where is it sitting on SPY this week? It's sitting at 690 and it's sitting at 688. This is the biggest levels for this week. I like this software because it basically auto plots for you the gamma. Where is the call resistance, or where does the selling pressure come in? It comes in above 685, right? And that's your 0 DTE call resistance or gamma wall. Okay, so this will be your natural resistance for the week. The high volume level is going to be 682. This will act like a magnet for price action to come down for liquidity. And right below that at 680 is your put support, or the 1-day min, which is your support from where buyers will step in. Okay. Your highest gamma level, once again, 690. And then the max level is 1-day max is going to be 691. Okay. Which is pretty much what all-time high. All right. So that's how market makers are positioned here. Market maker is positioned to potentially pull back into HVL at 682 or 680. That's one scenario. The other scenario is rally into 690 and 688. That's another gamma exposure level here, right? Or the third scenario is just chop people in the call resistance and the HVL, which is right below us, which wouldn't be unheard of because we have already gotten that this entire week. You can see the price action has been very inconclusive. This has been a constant battle between bulls and bears the entire week last week. Okay. So very straightforward. There is three plans. The three plans are accurately laid out in terms of the different expectations aligning with the Fed speak, which is the Fed data that comes out on Wednesday. And that's how you should be planning your day. Now, if you want to protect your portfolio, would I go ahead and buy SPY puts or would I go ahead and buy QQQ puts? Probably not. I actually like the idea of going long the VIX here if you really want some protection. It's not going to give you like a lot of return, but it's a better way to play the volatility that will come. So buying some $20 calls on VIX or maybe doing a debit spread of some kind might be a great idea. And if I do enter that trade, I will keep you posted on the Discord. But that's kind of like where I'm leaning towards, since I've already entered preemptively some hedges, some small hedges. Okay. Apart from that, I don't really have anything to add. I'm happy to take some ticker breakdowns. I know Rick was asking for a firm, so let's do that real quick. This was one of the tickers that was requested on the trading floor. So let's have a look at it. And let me just also add the intraday levels here. Okay, so from a trading standpoint for a firm, you are very likely to stay above the $65 level if there are no aggressive sellers and this week doesn't lead into aggressive selling price action territory. However, if you lose the $63 level, then you're likely going to come down into your previous level of support, which was around 47.50 all the way up to 50-ish. Okay. So just a heads up, that's going to be your intraday levels that will be important. You have a natural resistance, which you can see was rejected multiple times at around $70. Your two biggest gamma levels are actually at around $75, 74, 75. And this level here is pretty much right above the 1-day max. So price is likely to move sideways here on a firm for the week. But if you're talking about long term, then you might want to take advantage of the FA bot, right? Which is on Discord. So go here and check out the fair value first of all. Then at the same time, check out the health, right? Let the bot do the thinking for you and then do a quick stock, right? So if you look at the valuation, the stock is 22% overvalued. So I wouldn't buy this as a long-term investment. You can see the justification cross-check here. If you look at the health of the business, here is margins are net margin 6%, not really a very good margin. FCF margin is about 22%, a bit better. ROE is about 5 to 10%, which is all right. Current ratio, quick ratio, interest coverage ratio. Interest coverage ratio is a bit worrying. There's pretty high amount of debt in the business. You can see the cash equivalents are 2 billion. The debt currently is about 7 billion. This is not really a very good healthy business. Margins are very low. It's very constrained in terms of liquidity. That's what the issue is. You can see the overall summary here and have a read it on it. And if you look at the revenue growth, you'll see that the 1-year revenue growth is 37%, and then the 5-year revenue growth is about 44%. FCF growth has been pretty decent, but then has not been growing sustainably. You can see EPS is probably negative. That's the reason why it's not showing up. And you have projected EPS about 1.57, which is $1.57. So all in all, would I want to go and buy the stock as a long-term investment? No. Would I want to trade it in the short term? Not really neither. Because look at the amount of the war zone that you're in here. You'll have very strong support below at $60 all the way up to 65, which is where buyers have been coming in. And then your resistance is overhead at 70 and 75. It needs to break out of this zone if you want any chance of this moving anywhere, right? So it needs to break out of here. either above 77 or
ஜூஸ் கொடுக்கறனா கொடுத்துருங்க.
and below 60, 62. Okay. All right. So mute. All right. Okay. Any other breakdowns? Any other tickers you guys want me to have a look at? That's kind of a full comprehensive breakdown I did on Affirm. I can do another one if you guys need me to. Let me know in the chat. But apart from that, I am pretty much done with the breakdown. If you look at NASDAQ, you'll see a very similar story here, by the way, in terms of technicals. You're basically back to the golden extension, right? In the 38.2 and 23.6. And the highest it can go here, where it will then experience a little bit of a pullback, is going to be the 61.8 extension, which is just sitting at all-time high, right? So if you break this and start melting up, then this selling pressure that was sitting here is going to become buying pressure. Market maker will be forced to hedge by buying shares, and therefore it will send it up further. Okay. And if you reject here, this is, remember, where we saw a bunch of the call resistance, right? So this is where your selling pressure is, natural selling pressure. And if you reject, then what will happen? You will likely, you can see that's where SPX is, right? And you likely see a pullback into the put support or the HVL, and that's pretty much going to be somewhere down here as well. Now, I think Ivan has already posted the levels for this week. You can see, along with the write-up of every single thing here. So he's posted the levels for every single ticker. Please go have a look because he has already done it. And there's a little write-up that comes for all of them. Okay, so it's all here for you guys in terms of the plan already. Before the market open, the snipe list will come out. Okay. So also pay attention to that. All right. Well, I hope that was helpful. Let's see. Could you take a look at CCJ? Sure. Absolutely. CCJ. Okay. Cameo Corporation. This is, I believe it's oil and gas, right? Or is it? Oh, it's non-energy mineral.
It's nuclear energy. It's
Got it.
Cameco.
Got it. I thought it was oil and gas. I feel like it was, but no. Okay, in terms of gamma exposure, let's have a look. First of all, what's the market doing in terms of gamma? Sorry, let me just update this model real quick. So that has the most recent data. So, okay. So in terms of market making activity, and then I'll get into, let me just go have the commands pull up the rest of the stuff while this is going on. So first thing I want is health, CCJ, and second thing I want is the quick stock, CCJ, and the next thing I want is fair value, CCJ. Okay, let that being worked on. Okay, cool. So overall, in terms of short-term price action and gamma exposure, your immediate put support is right below you at $85. The HVL, which is a magnet point, is also just slightly below you. Call resistance, which is where majority of the selling pressure is going to come in, is going to be $91. You're currently sitting right at it or potentially above it. If you remain above the call resistance, then what's going to happen? You'll likely get up into $100 here, because the more the stock stays above this level, what will happen is that there'll be buying pressure to try to hedge these short positions that are here. You also have the second biggest gamma level at $95 right above you. Okay. The biggest gamma level though is $90, which is below you. And the put support's 85. Now, just in terms of risk to reward ratio and structure, this is broken out of the previous resistance here and is trying to base above this level here, right? So actually, from my perspective, this is a nice setup for a potential reclaim of the $100 level. If you don't get a abrupt intra-week pullback or news event that drives the entire market down, then you are likely to see this actually move closer to $100 if it was normal price action. However, you can't say that it's going to be normal price action because this is a FOMC week. So you're likely to see, pretty big move up and down in this, right? But if you ask me, it does look nice structure in terms of breaking the previous highs. And then we need to see if it can hold this $90 level. If it doesn't, what's going to happen? It's going to get down to the $85 level. And if it can't hold the $85 level, then it's going to try and retest the $77 level, right? And if it loses that, then the put support's down all the way at $70. This is likely where majority of the call exposure is sitting in terms of dealer level. Okay. So dealers have a lot of put exposure at 100 and also a handful at which are expiring 0 DTE at this $92 level. So dealers are incentivized to keep the price below this and above this, sending us into a sideways consolidation essentially in this level. Okay. So from a technical perspective, I do like the potential for it to get higher. But remember, this week is a funky week. You have FOMC, so don't expect that.
Got it.
Now,
Thank you.
let's
So
have a
better
look.
probably just to watch and see it
Yes,
and not take any short-term trades on it. And like you said,
absolutely.
focus on the VIX. Okay.
Absolutely. I would say don't take any short-term trades on it yet. Wait for after FOMC. Okay, let's have a
Mhm.
look if it's a healthy business, right? So first things first, the financial health. Gross margin 26%, operating margin, net margin 15%. Okay, not bad, not terrible for a mining business, right? FCF margin 26%, decent. ROE is between 5 to 10%. Okay. Interest coverage, they do have enough money to pay off debt. Debt to EBITDA is just over. It should be usually less than 1, but it's 1.13. So they have just a little bit more debt than their operational cash flow. Okay. Current ratio, quick ratio shows that they have enough assets to cover liabilities. Cash is just 559 million. Debt is around 700 million. Okay. Overall, not bad. I would say it's decent for the sector that it is in. Okay. If you look at revenue growth, 10-year revenue growth is almost zero. Revenue growth in the 5 years is 10%. Revenue growth in the past 1 year is 20%. If you look at EPS growth has been pretty decent. FCF growth 5 year is now 9%. That's not good. This is not a business that I would invest in long term, essentially, right? And then you have projected EPS. Okay, you can read all of this later. It'll tell you exactly what the breakdown is. And then if you look at valuation wise, it's very overvalued. The margin of
Mhm.
safety price here is $42. Current value is $91. Fair value is $50. So this is a very overvalued stock with very not like stellar financials. I personally wouldn't be long-term investing into this, but if you were thinking of trading it short-term, I would wait till after FOMC and wait till after this price action here is kind of figured out. Because right now it looks like market maker wants to keep this below this and above this. Because you have a very big range of put support here and a very big range of call resistance here, which means market maker wants to keep it here. Right?
I see.
Okay. Was that helpful?
Does That was very helpful. Thank you. And just one quick follow-up question.
Yep.
Does the financial analysis
Mhm.
and what you were just looking at, does that incorporate future growth of the nuclear energy sector?
It
Or is it saying
will
it's overvalued with
I
that
don't
assumption
think
already in there?
it's not gonna include that until it is actually become so this will the fair value will include it. Yes.
Right.
You can see that part of the model will be taking that into account. Yes. But the model is also taking into account how much it has expanded in the past in order to price that into the future. So
And
it's a modest model.
is the model based off of uh just like trade patterns, or is it based
No, it's
off
based
of
off
analyst
financials
reports
purely.
and just financials? Does it
Yes.
incorporate analyst reports
Yes,
and
it does as well.
projections? It
A little
does.
bit, but not
Okay.
too much. I've not given the model much room to play with analyst reports. Maybe I would say less than 10%.
Okay.
So the
So
valuation here is
it's
purely
conservative.
financials. Yeah, it's a very conservative valuation. This
Got
is
it.
like, this
Thank
should be
you.
the minimum price of the stock. You know what I mean?
Hmm.
I don't
Yeah,
like to
no, that's
calculate
that's
like the
helpful.
fairyland, like the what if scenario in terms of like, oh, what if this happens? What if that happens? This model is meant to keep you grounded in terms of reality. Like, this is what the price of the stock should be today based on the current financials, not based on the projected financials of the
Speculation.
business.
Hmm.
Yes, exactly.
Got it. That's very helpful. Thank you.
Yep, no problem. Okay, any other questions? You have anyone? I will go ahead and end the recording here, just in the interest of keeping the recording short and sweet. And then you guys can continue asking questions if you need. But other than that, I will see you guys in the recording, YouTube, whatever, next week.